Glad to be here.
Today we're looking at an analysis report on CIFR mining, stock ticker CIFR. It's titled Insane Growth. CIFR up 297% in 6 months. Is it too late to buy? The core argument is that the recent 40% drop offers a really compelling entry point.
Right. So let's jump right into the valuation argument.
Let's do it. The report makes a big deal of the potential 80% upside, but it seems to anchor that to the analyst consensus target of around $27 to $30.
It does. And right off the bat, relying so heavily on external analyst consensus targets really weakens the material's claim to proprietary analytical insight.
It feels like they're outsourcing the conviction.
Exactly. The weakness here is that the main justification for that upside is just Wall Street's average price target. For a savvy investor, that's not new information.
No, it just tells you what the market already thinks.
It just confirms the general optimism. It doesn't give you a deep, independent reason to buy this specific dip at this specific price. It needs to come from their own work.
So the technical setup is clear, the pullback, but the fundamental argument feels a bit borrowed.
Yeah, precisely. So the suggestion for improvement here is to really strengthen the material by modeling the valuation based on the internal catalysts.
You mean the AI pivot and their power assets?
Yes, those two things. Model the valuation based on those catalysts themselves, rather than just pointing to what other people are saying. That's how you show real, defensible conviction.
So if we're going to build a proprietary model, what does that look like? How do you actually structure that?
Well, you have to make the idea of the multiple upgrade the absolute centerpiece.
Okay.
Instead of just saying the target is $27, you use the competitor comparison they mentioned, Mara, Core, and build a clear relative valuation benchmark from that.
Because the real story isn't that they're a better Bitcoin miner.
No, not at all. The story is that they are becoming a data center stock. You have to explicitly project that valuation shift.
So moving from a volatile crypto multiple to a more stable, higher growth data center multiple?
You got it. And you have to show the math. What percentage of revenue needs to come from high-performance computing, or HPC, for the market to give them that new multiple?
That makes it much more concrete.
It does. You could even model it out in tiers. Partial AI integration gets you to X market cap, 50% HPC revenue gets you to Y, and so on.
And the $27 target becomes the result of the full transformation scenario.
Exactly. Now your argument is robust. Now you've earned that price target. It provides a much, much stronger defense for buying this dip.
That's excellent. It really shifts the source of the valuation from external to internal, which immediately boosts the rigor.
It does.
And if the whole valuation rests on that multiple upgrade thesis, then we have to zero in on the AI pivot itself. That really is the cornerstone of the bull case here.
And if that cornerstone isn't solid, the whole thing comes down.
Right.
So to fully justify that massive valuation shift from the AI pivot, the material absolutely needs to introduce specifics about the quality and the commitment of these HPC deals.
The credibility of the pivot is everything.
It is. I mean, the current analysis talks about massive HPC deals, but it's very light on the details of execution risk or the competitive barriers.
It's a huge leap, isn't it, going from crypto mining infrastructure to what hyperscalers demand for AI?
A massive leap. We're talking about specialized liquid cooling, insane power density requirements, low latency networks. That's a huge capital build-out.
So without those details, the pivot just feels like an announcement, not a fundamental shift that's actually happening.
The other half is proving they can actually deliver that power to these super specialized AI workloads.
And do it efficiently, without delays.
That's the suggestion. Bolster the analysis. Detail the specific advantages CIFR brings to HPC beyond just cheap power. And, critically, talk about the execution timelines.
Or the contractual commitments.
Yes, that's what validates the pivot and moves it from they have the energy to they have a competitive product that hyperscalers will actually buy.
How complex is this really? I mean, is this a quick refit, or are we talking about tearing down what they already have? The market needs to understand that capital risk.
It's significant. The tech is just different. The heat generated by AI chips is orders of magnitude higher.
So the examples need to address that technical gap.
They do. For instance, expand the discussion on the HPC contracts. Are these just one-year trial deals, or are they 5-year fixed-rate commitments? The length of the contract speaks directly to the stability of that future revenue.
Which is what justifies the data center multiple in the first place.
Exactly. Or, and this would be even more compelling, they could provide a brief analysis of how CIFR's existing power infrastructure is already optimized for this.
Oh, that would be powerful.
Hugely powerful. Show that their facilities have some unique modularity or thermal capacity that makes the shift less aspirational and more, concrete. prove that they're closer to being an HPC provider today than their competitors are.
That shifts the narrative from potential to actual progress. Okay, so let's move from the bull thesis to risk management. The analysis does have a bear case section. It mentions things like high volatility, dilution risk, gap unprofitability.
Right, but those are pretty generic industry risks, aren't they?
They could apply to almost any crypto miner.
That's the problem. The bear case, as it stands, is missing a huge opportunity to challenge the specific, unique, bullish catalysts that the report itself presents.
So the counter-arguments are about Bitcoin volatility, share dilution, which are relevant, but they don't actually probe the core assumptions driving this particular valuation.
They don't. As we just talked about, the entire thesis hinges on the AI pivot and the cheap power capacity. If those two unique catalysts fail, the whole thing collapses.
And the bear case needs to address those specific threats.
If you're going to claim these two things are unique advantages, your bear case has to argue why they might not be. That's where real analytical rigor comes in.
So what's the suggestion?
The suggestion is to strengthen the analysis by introducing counterarguments that directly try to dismantle that core bullish thesis. You have to prepare the investor for what happens if the fundamentals don't materialize.
It shows you've thought through the failure modes.
It increases credibility immensely.
Okay, so let's zero in on the cheap power catalyst. CIFR is pretty famous for having cheap, long-term secured power. Are we suggesting there's a risk there the author missed?
I'm suggesting a more nuanced challenge. We need to introduce a counterpoint about the longevity or security of that advantage.
Through what mechanism?
Through regulatory risk, analyze the possibility that local regulatory changes, maybe environmental laws targeting high-energy users, or even just expiring municipal contracts, could suddenly erode that cheap power moat.
That is a much more specific and potent bear case than just Bitcoin is volatile.
I agree. It's a direct threat to their core competitive advantage.
What's another example?
Another one would be to explore the possibility that the current valuation, that $14.99 price, already fully bakes in a lot of the AI pivot's success.
So the argument would be that the market has already priced it in.
Exactly. The stock is consolidating not because it's a dip, but because it's run out of near-term fundamental fuel. If the pivot is already priced in, then that 80% upside requires them to over-deliver, not just meet expectations.
That's a very sophisticated counterargument.
And it shows the reader you've considered market efficiency, not just sentiment.
Okay, this is all great. Let's finish up by looking at the delivery itself. I see what they're going for with the tone. It's high energy, very actionable, which fits the insane growth title.
Totally. And that energy is great, but we can strengthen the delivery without losing that enthusiasm.
So what's the critique?
Well, while the material does a good job generating excitement, the use of really informal conversational language in the final talking points, it risks compromising the credibility of the financial analysis that comes before it.
You're talking about the tonal inconsistency?
Yes. You see phrases like sitting at a juicy $15 level or the boat just came back to the dock to pick you up.
Which are great for engagement.
Great for engagement, but they clash pretty hard with the sophisticated arguments about multiple shifts and HPC technical specs.
It can make a skeptical investor wonder if the verdict is driven by enthusiasm or by the data.
Exactly. You lose credibility when the conclusion doesn't match the analytical gravity of your evidence. The voice has to be consistent.
The language should mirror the professionalism of the analysis.
Right. So the suggestion is to keep that high energy for the hook and for the final call to action, but make sure the financial summary and the strategic conclusions stay objective and precise.
Let the enthusiasm feel earned by the analysis.
Let it be earned, not just stated. So rephrase the excitement using more analytical language.
Can you give an example?
Sure. Instead of saying, this is a classic buy the dip scenario, use language that links the technical move to the research you've just presented.
Something like, the material demonstrates a strong technical setup where fundamental improvements, like these validated HPC deals, provide a solid floor for the current discount.
Perfect. That's exactly it. You're explicitly aligning the technical opportunity with the fundamental rationale. Now the enthusiasm feels justified by the numbers, and the investor is guided by expertise, not by hype.
That's a great shift. It keeps the excitement but really reinforces the intelligence behind the trade.